Hello, my CFA friends. How are you, my friends? Welcome to episode 6 of Ask Me Anything. Today's question comes from Dr. Investor 465, and it's in relation to a topic that is very, very important for both level 1 and level 2 derivatives. So if you are studying either level 1 or level 2, this episode is something you want to definitely keep an eye on. So here's the question. He says, please explain what is contango and backwardation from derivatives in the next AMA session. So before we start, I want to just remind you, please like the video, subscribe to the channel if you haven't done so yet, and do check my question-based revision at stoinov.co.uk. Before we go any further, I want to first talk about the cost of carry model, because that's actually going to be the formula essentially that determines whether we are in contango or backwardation. So there you go. You've got a little formula here which says that the futures price will be determined by taking the spot price today. So how much can I pay for the commodity, let's say today? Then I'll have to add the present value of the costs of carry. Notice here present value rather than future value. Adding the present value of costs of carry. So here think about what might be costs of carry. If it is a commodity, you probably want to store the commodity. You want to insure the commodity. Risk-free rate is also considered the cost of carry because for arbitrage purposes, you will need to borrow money today in order to buy the physical assets. And then we are subtracting any benefits of carry. So for financial assets, that would be dividends and coupons. And for physical commodities, the main one that we will be talking about today is convenience yield in a few slides' time. So key point here, to prevent arbitrage, we're going to have a cost of carry model. Start with the spot price. Costs of carry will increase the futures price, and benefits of carry will cause it to decline. So the moral of the story is that if collectively we have more costs of carry than benefits of carry, then our futures price will be above the spot price. And of course, the opposite is also going to be true. If our benefits of carry, so for example, if our dividends, our coupons, our convenience yield exceed our storage costs, then the futures price will be below the spot price. And we come to our first important word, which is the word contango. Okay, so contango occurs when the futures price is greater than the spot price. On the previous page, we said that the futures price will be greater than the spot price if the costs of carry exceed the benefits of carry. Okay, so what sort of market would you see that in? Well, could be the oil market, because in the oil market, we're going to have a lot of storage costs. Remember, these barrels of oil have to be stored either in onshore facilities or offshore tankers. So let's see the diagram. On the horizontal axis, I'm going to have maturity, so different maturities for these contracts. The vertical axis will represent the futures price. So because the futures price is greater than the spot, we are going to have an upward sloping curve. So firstly, the y-intercept will represent the spot price today because that's maturity of 0. So remember that a futures expiring today is as good as a spot contract. And then as we go into the future and away from today, I'm going to be observing an upward sloping curve. So what I mean by that is if a barrel of oil today costs me, let's say, $67, then in 1 month, so the 1 month future might be 69 and the 2 month future might be 72, for example. So we are seeing that as we go further into the futures price increases. Another concept you may want to pay attention to is the concept of raw yield or raw return. So let's say I want to maintain long-term exposure over 10 years, but I'm going to be doing this via 1-month futures contracts. So I enter this 1-month contract, but by the end of the month, the contract is about to expire, and I need to close it in order to avoid having to take physical possession of the commodity. So the act of closing an expiring futures contract and reopening a new 1-month contract would be known as rolling the futures forward. And so that rolling process will give us either a positive raw yield or a negative raw yield. In this case, we're getting a negative raw yield because we're in contango. So to explain that, let's say that I have gone long the 1-month contract. So long means that I've promised to buy. So I'm promising to buy at 69. So $69 effectively is going to be leaving my account because I'm going to be buying at 69. Then 1 month passes, assuming no change to the curve, no change to the spot price. When this contract expires, I end up holding an asset worth $67. So 69 has left my account, 67 has come back in my account, and you can see here that I've lost $2, which is essentially my negative raw yield. So being a long investor during times of contango, times of upward sloping futures curve, has its disadvantages, which is essentially this negative raw yield. Let's reverse the logic now and talk about backwardation. So in this case, the futures price is below the spot price. So futures price is below the spot price. Ask yourself, why should this be happening? Again, cost of carry model. Costs are less than benefits. So another way of saying this is benefits are greater than costs. This would occur in markets where we've got high benefits of carrying. Of course, we're talking about commodities. So the main benefit of carry on commodities is something called convenience yield, which is the non-monetary benefit of holding the commodity. Typically, if I'm a manufacturer and I need the raw material, copper, aluminum, steel, then there is this desire to hold the physical commodity in stock in order to be able to carry on producing my goods. So in agricultural markets, sometimes we see a spike in convenience yield because there are shortages. So notice that when we've got commodities in short supply, that will cause a spike in convenience yield. And of course, high convenience yield being a benefit of carry will push the markets in backwardation. So going back to our picture, the y-intercept will represent the spot price today. So let's say oil is trading at $70 today, but due to high convenience yield, due to shortages and so on, the futures curve is now downward sloping. And let's say the 1 month contract is at $69. So in this case, we're reversing the logic. If we were the long futures holder, this will give us actually positive raw yield because I am longing oil at 69. Remember, that means I'm promising to pay you $69 per barrel of oil in 1 month's time. The 1 month passes. Again, we are assuming no change to the spot price or to the shape of the curve. So when the 1 month expires, I'm going to pay you $69. You're going to give me a barrel of oil, but this barrel of oil will be worth $70. So in this case, I am getting a positive raw yield of $1. Okay, and let's consolidate our knowledge here with a real-world example of contango. And what happened is we got a very, very steep contango, very steep futures curve for oil during the GFC being the global financial crisis of 2007, 2009. So obviously, we know we had a financial crisis. We know we were in trouble. So there was reduction in demand and whatnot. So spot price of oil dropped to very low levels, $33 in January of 2009. So the spot price of oil was very, very low. Obviously, traders always basing prices on expectations. The futures market was a very different place. Even though we were in a crisis during 2009, traders were forward-looking, thinking already about what will happen potentially a year in the future, 2 years in the future. So the futures prices of oil were much, much higher, thus resulting in a very, very steep contango curve. Now, this got exploited by your crafty hedge funds because essentially what they realized is that the mismatch between the spot price and the futures price was wide enough for them to be able to capture arbitrage profits, meaning that the difference, the profit they would make, would be more than sufficient to cover any costs of carry. So something very ironic happened. You don't normally associate hedge funds with buying or renting tankers and storing oil, but that's basically exactly what happened during the GFC. So the hedge funds chartered tankers, essentially leased or rented tankers, which are massive ships where you can store your oil. Then they borrowed the money and bought physical barrels of oil, which they put on the tankers and, let's say, stored them for a period of time, 6 months, 1 year. It doesn't matter. We'll go through a numerical example in a minute. At the same time, they also shorted oil futures. Why would they do that? Because remember, the contango curve was very, very steep. So they were holding the physical oil, waiting to be able to sell it via the expensive futures contract in the future. And the arbitrage worked because the profits that they would make from the sale of the oil would outweigh the cost of borrowing and the cost of storing the oil. Okay, quick numerical example here to illustrate what we mean. There's your steep contango curve, where in January of 2009, oil is trading at $30 per barrel, but 1 year later, the futures price for delivery 1 year later is at 70. So you can see here massive, massive contango, $40 contango. Let's say that these hedge funds can borrow money at 5%, and also they can rent the tankers, store the oil, insure the oil. All relevant costs of carry amount to $13.5 per barrel. So let's see what's going to happen. We're going to do the calculation per barrel of oil. So remember, a barrel of oil costs $30 today, but we're going to engage in arbitrage. We don't have the money. So we're going to have to borrow $30. So borrow $30 at 5% for 1 year. That's $1.5 per barrel that we need to pay in the future. Also, we need to store the oil. So we're going to rent the tanker. We're going to stick the barrels of oil on the tanker for 1 year. That's going to cost us $13.5 per barrel. So the total cost will be $15 per barrel for 1 year. Now, remember that the profit that we are going to make is the difference between the futures price and the spot, because we are essentially buying the oil today at 30, selling it in the future at 70. So the arbitrage profit here is the delta between 70 and 30. That's $40. Take away the $15 of storage costs and cost of borrowing, and that's going to leave us with $25 of arbitrage profit per barrel. So as you can see here, your crafty hedge funds found a way how to make money by essentially renting oil tankers, something that I wouldn't have expected to be the bread and butter business of a hedge fund. I hope you found this AMA session useful, guys. I believe that contango and backwardation is going to be very important for both level 1 and level 2 derivatives. If you want to become a friend of the channel and support me, please do so at stoinov.co.uk. You'll also get my question-based revision. And if you want your question to be featured in one of the upcoming AMA sessions, email it to stoinov.financial@gmail.com. Thank you very much for watching and have a great day.